Hello student, this is day 3 of the FR revision session, and in this session we'll be discuss a few accounting standards, the key accounting standards, and the practice sessions related to MTQs. We'll practice some MTQs of the key accounting standards. So let's start with IAS 32 and IFRS 9 financial instrument, which is one of the key standard of FR exam. So this is the question. Now let's discuss this question. As we know that in IFRS 9 and IAS 32, we have to deal with financial assets. We have to deal with financial liabilities. And also we have to deal with the convertible loan notes. Now this question says that on 1st September 20X3, L factored 2 millions of receivable to finees. So this is basically related to debt factoring of receivables. In the case of debt factoring, sometime it happens that when the receivables have been transferred to the factoring company, then we de-recognize this asset and recognize gain. But when we receive something from the factoring company and the debtors has not been recognized, then it is to be treated as a loan. So in this situation, the receivables have been factored at a price of 2 million to finees, and the company received an immediate payment of 1.8 million. The value of receivable is 2 million and we received 1.8 million immediately. Under the factoring agreement, any receivables not collected after 4 months will be sold back to L. It means that this is the kind of factoring which we call with recourse factoring, in which the bad debt is not the responsibility of the factoring company, rather than it is a responsibility of the company laid law. So if the factor company is able to sell back to the company, it means we have not transferred the risk of this investment. So let's see what is the question related with this. Question number 1. Which of the following is correct regarding late laws factoring of trade receivables for the year ended 30th September 20X3? So we received 1,80,000 now. Number 1, 200,000 should be recorded as an admin expense for the disposal of the receivables. This is not a correct option. Number 2, the receivable should be removed from the statement of financial position. Clearly not, because the risk have not been transferred. This represents a without recourse factoring agreement. This is a with recourse factoring agreement. And the receipt of 1.8 million should be treated as a loan. So in this case, this amount collected is treated as 1.8 million loan. So it's loan payable credit. And the excess amount will be treated as expense. So answer is D. Next part is, on 1st October 20X2, L sold some maturing inventory having a cost of 4.5 million to a bank for its fair value of 5 million. So cost of inventory item is 4.5 million and it was sold to a bank at a price of 5 million. Under the terms of the sale agreement, L has the option to repurchase the inventory. It's basically a transaction covered in an IFRS 15 revenue recognition. So we have an option to repurchase the inventory after a period of 10 years at a price of 7.4 million. At this date, the fair value of the inventory is expected to be 11 million and the repurchase price reflect an equivalent annual rate of interest of 4%. So in case of sale and repurchase agreement, we have to consider whether the control of inventory is with L or it has been transferred. So if the sale is recognized as revenue, we have to de-recognize our asset. Otherwise, we have to retain the asset. So here you can see here that an option is there, but company will buy this inventory at a price of 7.4 million, and it's this state the inventory will be valued at 11.11 million. So it means the exercise of option is very likely. So that means the company will buy back this again. So if the company's buyback option is attractive, it means sale has not recognized. So this 5 million provided by the bank is basically a loan. So instead of de-recognizing as the inventory or recognize it as a sale, we have to recognize this loan as cash debit 5 million and loan credit by 5 million. And afterwards, when we'll pay 7.4 million, the excess will be recognized as an interest cost. So we have a question related with this. Which two of the following items should be recorded in financial statement of L for the year ended September 20X3 in respect of maturing inventory level? So as you can see here, what is the current transaction which is right? So basically we have received 5 million now, and the interest rate is 4%. So 5 million we received on 1st October. 4% interest rate is 20,000. So interest is 20,000. So the liability is basically 5,20,000 at the end of the year. So value is in millions, so it's 200,000. So first option is right. It's a finance cost. And year end, the loan value is 5.2 million. Rest are all wrong answer. As it is a loan, so what is the original loan value? It is 5 million. The equivalent rate of interest is known as finance cost. So finance cost is 5 million into 4% is 200,000. So total value of the loan is now 5.2 million. This is your interest cost. This is your loan value. L issued $10 million convertible loan notes on 1st October 20X2 that carry a nominal rate of coupon rate of 5%. Redeemable on 1st October 20X5 after 3 years. A similar loan note without the conversion option would have required to pay an interest rate of 8%. This is the effective rate of this convertible loan note. Relevant discount rates are shown below. We have to consider this effective rate. What amount should be recorded in equity in respect of convertible loan notes issued by L? So we have to use the split accounting. And from this figure, that is 10 million, we have to identify the present value of future cash flows as a liability, and the balance would be then equity. So we have here cash flows, relevant discount factor, and present value. And as we have 3 years, so it's 20x3, 20x4, and next year is 5. First of all, we will take the coupon rate, and coupon rate is given as 5%. So 10 million into 5%. So it's 500. Redeem at 10 million. So we have 500,000, then 500,000, and then 10,500 principal plus interest. Discount rate, we'll use the effective rate. Factors are given 0.93, 86, 79, 79. So let's find out the present value. It's 465, 430. And now the total is 9190. So this is the liability component. The total value of the instrument is 10,000. So from 10,000, if we deduct the liability component, the rest is the equity component on the issuance date, and that is 810. This is the equity. So the relevant question is, how much is the equity? 81000 is the equity. Next question is, which of the following statement regarding the convertible loan note is not true? The convertible loan note will affect gearing due to the liability component being different to the equity component. Now, this is true because in case of convertible loan note, we have liability as well as equity. So it's going to affect the gearing ratio. The equity amount will remain fixed until the date of conversion. This is also the same. Will not change the value of equity till the date of conversion. The liability at 30th September will be 10 million. At the end, we have to pay this, so our liability would be 10 million. The 5% interest will be charged to the profit and loss account is a finance cost. This is wrong because the finance cost is at the rate of effective rate rather than the coupon rate. So answer is D. Next is, applying the principle of split accounting to convertible loan note is important to satisfy which of the following qualitative characteristics. We have ISB's framework, and under this framework, we have some qualitative characteristics which are fundamental as well as enhancing. So here we have 4 characteristics. If we apply split accounting, that means we have considered loan into its real form, that is some part as a liability and some part as a equity. If we are doing this, which of the characteristics we are applying? So one is relevance. It has no connection with the relevance. Verifiability, again, no connection with verifiability. Timeliness, again, no connection with timeliness. But this is showing the faithful representation. That is the reality. It's showing reality that it is not a loan note. It is rather a compound financial instrument. Next question is, the following trial balance extracts relates to Howard at 30th September 20x5. Convertible loan notes liability component at 1st October 20x4 28508. 5% loan note and equity instrument 6,000. The following notes are relevant. The convertible loan note are 8%. This is the coupon rate. 30 million is the original value. Issued on 1st October 20x4 at par. The effective rate is 10%. The directors correctly split the instrument into its 2 components at 1st October, but has nothing done anything further. So that means the liability is still at the original value 28508, and we have to record this liability at amortized cost. The second thing is that the 5% loan notes above were issued at par of 10 million, but Howard Co incurred 400,000 issue cost. the loan notes have an effective rate of 8%. What to do with this issue cost? The third one is the equity investment relates to 1 million shares in Kapoor, an unrelated entity. During the year, Kapoor paid a dividend of 10 cents per share, and at the year end, the fair value of each share is 7. Which of the items included in the trial balance extract will be classified as a financial instrument? So all these are financial instrument. Financial instrument comprises of financial assets, financial liabilities, and equity instrument. So all classify into this. What should be the value of liability element of the convertible loan note at year end? So at year end means the initial value of liability. We have to find out the amortized cost. That is 28508. Now add finance cost at the rate of 10%. 28508 into 10%. This is 2851, and paid coupon, which is 8%, and it is paid on nominal value, par value. So it's 2,400. So year end value is 28959. This is CF, the closing balance of liability. Next, what finance cost should be shown in the statement of profit and loss in respect of the loan notes? So loan note value is shown as 10,000. Issue cost is not yet deducted from this. The rule is that from the loan note, we have to first deduct the issue cost and make it a fair value. So this is basically the initial value. And what is the finance cost percentage? The finance cost percentage is 8%, and the interest rate is 5%. So how much interest we have to record? Interest we have to record at this initial value, 9,600 into 8% effective rate, that is 768,000. What income should we record in the statement of profit and loss in relation to equity investment? One is we get dividend of 10 cents. Dividend income. 10 cents per share. So we have number of shares is 1 million multiplied by 0.10. So it's 100,000 dividend income. And we have also recognized the gain. So let's see what is the gain. So we have purchased this 1 million shares. Dividend 10 cents. Fair value is now 7. So what is the option available? 100,000 is your dividend income and a gain. So it means this is the correct answer because 100,000 income and the 1 million gain. Last is Howard is uncertain of how to treat professional fee, that is transaction cost, on for which of the following investment should this fee be capitalized as part of the initial value? If the assets classification is FETOCI, then this needs to be capitalized. Otherwise, no capitalization. And in case of amortized cost investment, also we need to capitalize this. Another question relates to this IFRS 9, IS 32. S issued 2 million 6% convertible loan notes on 1st April. The loan notes are redeemable at par for cash or can be exchanged for shares on that date, that is 31st March, after 3 years. Similar loan notes without the conversion option carries an interest rate of 9%, which is the effective rate. So this is the relevant figure. On 1st April 20X3, SO purchased 50,000 shares at 4 per share, incurring transaction cost of $4,000. The intent is to hold the shares for trading, that is FVTPL. By 31st March, the shares are trading at 7 per share, 4, and now it's 7, 3 gain. In addition to the gain on investment, also received a dividend during the year. In accordance with IS 32, which of the following describes an equity instrument? What is the definition of an equity instrument? So, first one is a contractual obligation to deliver cash. This is a liability. A contract which give rise to both a financial asset of one entity. This is the definition of financial instrument. A contractual right to exchange financial instrument with another entity under potentially favorable condition. This is again not the definition of equity. A contract which is evidence of a residual interest in the assets after deducting the liabilities. So equity is the residual interest in the assets after deducting liabilities. In accordance with IS 32, how should the issue of convertible loan note be recognized in the financial statement? As a debt, wrong. It is to be shown as debt plus equity. As equity, no, it can't be recorded as equity alone. As debt and equity, because the convertible loan notes contain certain elements of both. So answer is C. What amount in respect of convertible loan note will be shown under non-current liability at 1st April 20X2? 1st April 20X2. That is the initial value. So we need to find out liabilities value. So we need to find out the present value of future cash flows. So we have year, cash flows, relevant factor, and EV. There are 3 years. So interest is 2 million loan and 6% is the interest rate. So it's 1,20,000. And then it will be redeemed at 2 million. So first cash flow is 1,20,000, 1,20,000, and it's 2120,000. Discount rate 917,842. It's 917. It's 842,772. This is the present value. If we total this value, this is the liability component. Rounded to this figure. In accordance with IFRS 9, what amount will the SPDCO shares be shown under investment in equity instrument as at 31st March 2000 and X4? So let's talk about investment. So investment X4. So we have purchased this investment 50,000 shares at 4, and now the value is 7. So we need to record capital gain. So 50,000 at the rate of 7. We have to show here 3,50,000. This is the closing balance. Where should the gain on the investment and the dividend be recognized in the financial statement for the year ended March 20X4? The gain on investment, because it is FVTPL, so it is to be recognized in income statement. And as far as dividend is concerned, it is always recognized in income statement. So answer is both profit and loss. Next question is about IS 21 foreign exchange and something about IAS 12 taxation. So under IAS 21, we have to consider what two issues, that is what is presentation currency and what is functional currency. So by definition, presentation currency is the currency in which an entity prepare financial statement. And functional currency is the currency of the economic environment in which an entity operates. So a company's functional currency and presentation currency might be same or might not be. So if a company has any foreign currency transaction, that is receivables or payables and anything else, so at initial recognition, we have to translate this as per the transaction date exchange rate. While subsequently, we have to see that whether this item is a monetary item or a non-monetary item. If it is a monetary item, then we need to retranslate it again. And if it is a non-monetary item, then no need to translate it again. No translation is required. And in case of any exchange gain or loss, whatever is the exchange gain or loss, we have to recognize in profit and loss account. Now see the question. Vans buy and sell goods in chromits, but has a functional currency of dollar. Vans purchase goods for kroner, chromits 10,000 on 1st September, and the year end is December. And at the year end, this amount is outstanding. That means 10,000 payable is outstanding. In functional currency is dollar. So Vans is preparing its financial statement in dollars. Vans also sold goods on 1st September for 60,000 chromits and on 1st October received 30,000 and remaining is unpaid at 31st December. So it's partially paid and partially unpaid. What gain or loss should be recorded in the statement of profit and loss for the year ended December in relation to the payables recorded of the purchase goods? Now we have 10,000 purchases. So purchases debit and payables credit. So initially we have 10,000 of transaction. So first of all, we have to convert this transaction at the rate of the transaction date, which is 1st September. So the rate is 10:1. Chromits 10 is equal to $1. So we have to convert this into $1. So what we need to do, KR 10,000 divided by 10. So it's $1,000. This is my initial payable. At year end, December, the rate is 8:1. So now the same $10,000 is to be divided with 8 and the value is 1250. Now see, we have a liability at the beginning at the transaction date 1,000. Now liability is increased due to exchange rate and there is an increase of liability of 250. An increase in liability of 250 means there is a loss. So exchange loss is debit and the liability is credit. So the answer is 250. Next is, what gain or loss should we record in the statement of profit and loss for 31st December in relation to sale of goods? Now, sale of goods took place on 1st September for 60,000. So my initial receivable is 60,000. Then 30,000 received and outstanding is CF is 30,000. So basically, we have to convert 30,000 first of all. So 30,000 at the rate of September, that is 10. So it's $3,000 receivable at the beginning. And now this is outstanding 30,000. 30,000 has been received. So it is at the rate of 8. So that means 30,000 divided by 8. It's 3750 carried forward receivable. So increase in receivable by 750, receivable debit, and this is my exchange gain. So exchange gain of now see the figure. It's total gain on loss. So we have to also calculate the first one, that is the settlement gain on loss. So 3,000 brought forward of the amount, and amount was settled on 1st October. So 1st October rate was 10.5. So on settlement, it's 30,000 divided by 8, 10.5. So it's 2857. So at the time of settlement, this value results in loss 2857. So initially it has a loss, and then subsequently we have a gain. So overall 750 is the gain, 143 is the loss. So we have 607 net gain. So answer is B. Next question is, which of the following statement below is or are true? Statement number 1. The inventory purchased on 1st October should be translated at the closing rate if the goods remain in inventory at 31st December 20x1. Now, inventory is a non-monetary item and we don't translate the non-monetary item. So it's false. The foreign exchange gain will be added to the revenue of the year. The foreign exchange gain is to be shown as an income. So this statement also false. Next is about tax. The assistant accountant estimate the tax expense for the year is 43,000 for the year ended 20x1. However, he had ignored deferred tax. At 1st January, the deferred tax liability was 1,30,000, and at the end we have a temporary tax differences of 3,60,000. Tax rate is 25%. All the movement in deferred tax is to be shown in profit and loss account. So brought forward deferred tax liability is 1,30,000 is DTL. Closing deferred tax liability we have to find out. So we have taxable temporary difference of 3,60,000. Income tax rate is 25%. So 3,60,000 into 0.25. So we have 90,000 liability. So there is a fall in liability of 40,000. There is a decrease in liability of 40,000. So decrease in liability is income 40,000, and we have an expense of 43,000. So 43,000 is an expense and 40,000 is an income. So net expense is 3,000. What will be recorded is a tax expense in the profit and loss account. So it's 3,000. The assistant has discovered that there is a debit balance of the trial balance of 3,000 related to the under or over of the tax from the last year. So what we need to do, the tax estimate, and we need to add under provision, and we have to less or deduct over provision. In this, The debit balance was given in the trial balance, and whenever it's a debit balance, it reflects under provision. So what to do with this under provision? Increase the tax liability by 3,000? No. Decrease the tax liability? No. Increase the expense because we have to add it. So increase the expense by 3,000. So answer is C. Now let's talk about IAS 16 and IAS 38 along with IAS 36. Tangible assets, property, plant and equipment, intangible asset, and the impairment loss. Now in case of IAS 16 property, plant and equipment, we know that the initial measurement of any property, plant and equipment is at cost. So we should be clear about what reflects cost. So cost comprises of purchase price, import duties, installation cost. If there is any taxes, then if taxes are refundable, we'll not add this into cost. If it is non-refundable, then it is part of cost. Similarly, if there is any training cost involved, it is to be charged in profit and loss account always. If there is any testing cost, it is to be capitalized, so as the borrowing cost. And afterward, the asset is to be recognized at either the cost model, that is cost minus depreciation, or we have an option that is asset can be revalued. And if we opt revaluation model, the value might be increased, result in revaluation surplus, or it might reduce in value that results in revaluation deficit. Now see the question. Abina Co prepare financial statement at 30th June. During the year and the company spent 5,50,000 on a new plant. How this 5,50,000 comprises of? Plant cost is 525, that is to be capitalized. Delivery to the site, same, is to be capitalized. Building alterations to accommodate the plant, this is also part of this capitalization process. Cost of initial testing of the new plant, this is also need to be capitalized. Plant operator training cost. Training cost is part of profit and loss account. So in accordance with IAS 16, property, plant and equipment, what is the value of addition to plant for the year ended 30th June 20XY? Let's count. It's 525. Delivery to site 3, 528. And it's 12. So it's 528. And 2, 542. So 542 we need to capitalize. Abina's fixtures and fittings were purchased on 1st July at a cost of 50,000. The directors have depreciated them on a straight line basis over its useful life of 8 years, assuming a 5,000 residual value. So we have life 8 years, residual value 5,000. On 1st July 20X4, that is after 2 years, the directors realized that the remaining life is 5 years. Remaining life is 5 years. So original was 8. We have used 2. So life should be 6, but life is now 5 years. There is no change in the residual value. Which of the following is true in relation to change in the remaining life of the fixtures and fitting? It is a change of accounting policy. A change in life is not accounting policy, rather it's accounting estimate. It is a change of accounting policy. Again, it's not a change of accounting policy. It is a change of accounting estimate, yes, but it's to be applied prospectively, not retrospectively under IAS 8. So the correct treatment, it is a change in accounting estimate, which should be applied prospectively under IAS 8. In accordance with IAS 16, what is the depreciation charge against fixtures and fitting for the year ended June? So our original cost was 50,000. Original scrap value was 5,000. Original life was 8 years. So per annum depreciation was 45 divided by 8. It's 5625 and we use it for 2 years. So 11,250 was the depreciation. So the book value was 50,000 minus 11,250. So it's 50,000 minus 11,250. It's 38,750. It's the book value at the time of change in life. Now the revised life we have to consider 38,750 minus scrap value divided by useful life, which is now 5 years. So what is the per annum depreciation? 750. So this is depreciation for the year. Next is about IAS 38. So under IAS 38, if there is any research cost, the treatment is it is to be shown in profit and loss account as an expense always. And if there is any development expenditure, then we have to see whether the criteria is satisfied or not. If not, then it's an expense. If criteria is satisfied, then we will capitalize this development cost. Let's see. Abina began a research project on 1st October 20X3 with the aim of developing a new type of machine. If successful, Abina will manufacture the machine and sell them to customer as well as using them in their own process. During the year ended June 20X4, that is from October 23 to 30th June 20X4. The cost of 25,000 was incurred on conducting feasibility studies and some market research. So this is feasibility and market research cost. During the year ended June, a further 80,000 was incurred on constructing and testing a prototype of the machine. Question is, in accordance with IAS 38, what is the correct treatment of the 25,000 cost incurred on the research project? So as I told you, research is always an expense. So the relevant answer is they should be written off to profit and loss as an expense as they are research cost at this date. In accordance with IAS 38, which of the following is true when Abina's moved to the production and testing stage of the prototype during the year ended June 20X5? The project has moved to the development stage. If the IAS 38 development expenditure criteria are satisfied, Abina can choose whether to recognize as an intangible asset, then it would be mandatory, not a choice. So this is wrong. The project is still in research stage. This is also wrong. It is in development stage. The project has moved to the development stage if the IAS 38 criteria is satisfied, must recognize as an intangible non-current asset. So answer is C. Another question. During the year ended December 20X8, L built an extension to its head office. The cost associated with the construction are as follows. Land acquisition, we have 10 million of land acquisition. Fee for environmental certifications and building permit, architects and engineer fee, construction material labor cost including unused material 6.6. At 30th September, the date when the head office extension becomes available for use, the cost of unused material on site amounted to 0.5. At that date, the total borrowing cost incurred on a loan which was used for this purpose amounted to 0.8 million. The borrowing cost that is incurred on the construction of an asset needs to be capitalized. So for the year ended December, how much should be capitalized against the construction of an head office building? So we have the cost of land, 10 million. This needs to be capitalized. Fee paid for environmental certifications. We have architects and engineers fee. And we have this minus the unused stock. So it's basically 6.1 and the borrowing cost 0.8. So answer is we have 10 plus 0.5 plus 1 plus 6.6 minus 0.5 plus 0.8, 18.4 million. So answer is A. L incurred further expenditure on the head office extension after it had been completed. Which of the following would qualify as capital expenditure? Property insurance premium incurred, it's a revenue expenditure. Installation of new office fixtures and fitting, this is capital expenditure. Marketing cost is always a revenue expenditure. Maintenance and relocation of components, computers, it is also maintenance and repair is revenue expenditure. So answer is B. At 31st December, the directors of ELCO decided to adopt the revaluation model of PPE. In accordance with IAS 16, which of the following statement is false? In subsequent years, the depreciation will be based on the revalued amount of the head office building as opposed to its cost. This is true. Any revaluation gain is recognized in OCI and any revaluation loss is recognized in profit and loss account. This is also true. Each component part of the head office building is revalued separately. Each class is to be revalued separately rather than each component part. The residual value in life must be reviewed at each year end. This is also true. This is wrong. Is revalued separately. Each component part is revalued separately rather than for each class we have to apply the revaluation model. Next is about IAS 36. So under IAS 36, we need to identify impairment loss. When assets carrying amount is more than its recoverable amount, there is an impairment loss. And if we are not able to find out the impairment of an individual asset, then we'll find the impairment of cash generating unit. And once we identify the impairment of cash generating unit, then we have to apply it in the order of allocation. First against the damaged asset, then on the goodwill, and afterwards on other assets on pro rata basis. So L acquired 100% of a subsidiary on 1st January. The carrying amount of the asset in the consolidated balance sheet immediately before an impairment review were as follows. So it's 1.42 million brand name PPE 6 current asset at recoverable amount. It's already at recoverable amount, 11.8 million. The recoverable amount was estimated at 9.6 million and the impairment was deemed to be 2.2 million. Assuming it's a cash generating unit, what is the carrying amount of the brand after impairment loss? So impairment is given as 2.2 million. Loss is 2.2 million. It's 2.2 million. There is no damage asset given. So first we have to apply this against the goodwill. So what is the goodwill? Goodwill is given as 1.4 million. So offset this against goodwill first, 1.4 million. Remaining loss is 800. And then we need to allocate this on goodwill is now 0. Brand name and PPE because this is not subject to impairment. 2 and 6. So we need to allocate this on the basis of 2 and 6. So brand value is 2, PPE is 6, total value is 8. So loss of 800 on brand, it's in the ratio of 2 divided by 8. So the impairment on brand is 200, 200,000 or 200. So what is the carrying amount of the brand after this? So brand value was originally 2 million. Impairment charged is 200. So the carrying amount is 1800, that is 1.8 million. Answer is D. Which, if any, of the following statement regarding impairment review is or are correct? Normally, we apply impairment on the basis of indicators of impairment. There are two types of indicators. One is internal and other is external. And there are few assets on which annual impairment review is needed, such as goodwill, intangible asset having indefinite useful life. See this example. At the end of each period, an entity should assess if there is any indication the asset have been impaired. True. Annual review are required on all intangible asset with indefinite useful life. This is also true. So both 1 and 2 are correct options. Another question is, Nowhere is an airline and prepare its financial statement to 31st December each year. It purchased an aircraft at a cost of 15 million on 1st Jan 20X5, having the following details. The aircraft comprises of airframe, engines, engine testing cost, or interior of the aircraft. Residual value is given. Useful life of each component is also given. The company depreciates it on straight line basis. To fund the purchase of aircraft, it borrowed 10 million euros on 1st Jan 20X5. The interest on the loan is insignificant. It should be ignored. The loan was due to be repaid in 4 equal installments, with the first repayment being made on 1st January 20X6. Following are the exchange rate. The functional currency is dollar. So we have loan in euro and we have to record it in dollar. On 31st December, a significant engine malfunction was discovered. As a result of this, aircraft was grounded. The company cannot reliably estimate a recoverable amount of the engine. The aircraft, including the engine, can be treated as a cash generating unit. In accordance with IAS 16, PPE, which two of the following statement is or are correct? The depreciation charge should be recognized in profit and loss unless it is included in the carrying amount of another asset. This is true. When fair value is used to measure PPE, then all other assets must be measured using the same principle. It is on class to class basis, not for every asset. The cost of safety inspections that are legally required to operate can never be capitalized as part of the cost of an asset. Yes, it is to be capitalized as overhauling cost. At the very least, the residual value and useful life should be reviewed at each year end. This is also true. In accordance with IAS 16, what is the total aircraft depreciation to be charged for the year ended December 20X5? Now, on the basis of a straight line, we need to identify depreciation. So first one, it's 7500 divided by 20. So we have 375. Second one is 4400 divided by 8. So we have 550. Third one is 600 divided by 8. So we have 75. And fourth one is 1400 divided by 5. So it's 280. So total depreciation is 1280 on the basis of straight line. In accordance with IS 21, the effect of changes in foreign exchange rate, what is the total balance of loan liability at 31st December 20x5? Now let's see what is the original loan value. The original loan value was 10 million at the beginning of 1st January 20x5. So initial loan was 10 million. 10 million divided at the initial rate, that is 1. So it's $10,000. It is to be paid in 4 equal installment. So on 31st December, one installment we have to pay. So that means 2,500 is being paid. So paid amount is 2,500. Now, loan is a monetary item, so we need to adjust this loan value at the closing rate. That is 31st December 2005, and the rate is 1.25. So 1.25. Now it's 1.25. So 10,000 minus 2,500. So it's 7,500 divided by 1.25. If we take the original value as 1.25, the requirement is that the original loan is 10 million. The loan was due to be repaid in 4 equal installments, with first being made on 1st January, not on 31st December. It means the outstanding loan was 10 million at the beginning, and now it's also 10 million. So original rate was 1, and now the rate is 1.25. December 2005. So it's 1, and now it's 1.25. So let me check whether we have to multiply or divide. The rate is given. Our functional currency is dollar, and rate is given as €1 equal to $1. So it's an indirect quote. So in order to convert euro into dollar, we have to multiply rather than we have to divide. So the whole value is not right. So first of all, 10,000 euro multiplied by 1. So we have $10,000. Then 10,000 euro. Now the rate is 1.25. It's 12,500 USD. Liability is increased by 2,500, and this is loss. Total value of liability is 12,500. So this is the liabilities total value. At 31st December 2006, the balance on the liability for the loan is 7.5 million euro. How? 10,000 euro. One installment paid on 1st January. Now it's 7,500. At 31st December 7, the balance is 5 million euro. In accordance with IS 21, which two of the following correctly reflect how the foreign currency transaction should be reflected in the financial statement for the year ended December 20x7? The liability at 31st December should be stated at 5 million. The balance is 5 million euro. What is the rate at 31st December 20x7? it's 1. 1 means the liability is 5 million euro. So convert as 1. So it's 5 million euro. Answer is A. Next is a foreign currency exchange gain of 500,000 should be reported. Now, previously, the last year end, the rate was 31st December, it was 1.1, and now it's 1. So previously it was 1.1, and now it's 1. So we are dealing with loan. So previously it was 5.5 million loan, and now it's 5. So reduction in liability by 0.5. So there is a gain. Reduction in liability is always a gain. So we have A and B. In accordance with IAS 36, which of the following statement is correct? The company must not recognize an impairment loss for the engine since the recoverable amount cannot be reliably estimated. And must determine the recoverable amount of the engine using the depreciated replacement cost method, and must write the carrying amount of the engine down to the residual value since the recoverable amount cannot be reliably estimated, and must determine the recoverable amount and allocate a proportion of any impairment loss to the engine based on their carrying amount. Now, if this is considered as a cash generating unit, then we have to identify impairment and allocate on engine on the basis of their carrying amount. Now let's talk about IFRS 16 leases. So under IFRS 16, basically we have to deal with the accounting for lease with the perspective of the lessee, and we have to deal with primarily two things, that is what is right to use asset, how to value right to use asset, how to account for, how to calculate depreciation, and then present value of lease obligation and subsequent treatment of the lease obligation value. On 1st October 20X6, Fino entered into an agreement to lease 20 telephone for its team of sales staff. The telephones are to be leased for a period of 24 months at a cost of 240 per telephone per annum, payable annually in advance. The present value of these payments at 1st October is 9164. There is an exception in IFRS 16 that if the lease is basically a short period one or is of low value item, then exception is applicable. On 1st April, Fino entered into an agreement to lease an item of plant from the manufacturer. The lease required 4 annual rental beginning from 1st April in advance. The plant is having a useful life of 4 years. And the present value of lease payment is 3,50,000. Cost of capital is 10%. Which of the following applies to the principle of faithful representation to the above plant lease arrangement? Recording an annual rent expense in Fino's statement of profit and loss account. So rent is not considered as expense. Expense any interest on a straight line basis over 4 years. This is against not the correct treatment. Record asset in the statement of financial position to reflect control on the basis of substance over form, that is showing the true reality. Legally, the ownership is with lessor, but keeping in mind the substance and reality, the control is with lessee. So lessee will recognize the asset. How much would be charged to Fino's statement of profit and loss for the year ended September if Fino applied the exemption permitted under IFRS 16 leases? So whatever is the lease rental, we have to charge these rental as an expense. So these rental value, how much is the lease rental value? 40 per telephone, and there are how much? 240 per telephone, and we have 20 telephone. So rental per annum is 240 into 24,800. This is the annual rental, and annual rental is to be recognized in profit and loss account if exception is allowed. What would be the carrying amount of the right to use asset at 30th September 20x7 against the second plant? 30th September 20x7. So when we calculate right to use asset, it is equal to liability and any initial cost. So the liability is 3,50,000. There is no initial cost. And in order to calculate this, we need to find out depreciation, and life is given, which is 4 years. Annual annual rental is 100,000. So we have carrying amount at 30th September 20x7. So 6 month depreciation is applied. So 3,50,000 is the assets value divided by 4. Per annum depreciation is 87,500 into 6 by 12 for 6 months. It's 43.75. So 350 minus 43.75 is the book value. 306.25. So it's 306,250. What interest would be charged to Fino's statement of profit and loss for the year ended September against this lease? So present value of liability is given as 3,50,000. It is given. Total lease payment is 350. So that means we have to deduct the advance rental, 100,000. And the liability at the beginning is now 2,50,000. And we need to apply the interest rate given in the question, which is 10% annual interest rate. So interest rate is 2,50,000. And as we have to calculate interest of 6 months, so interest is 25,000. So it's half, that is 25,000 of interest. Wait a minute. 2,50,000. 2,50,000 into 0.1. 25,000 is the interest of the whole year into 6 by 12. It's 12,500, not 25,000. So answer is A. Applying the principle of IFRS 16 leases to capitalize the plant and recognize the lease liability would have what impact on the following ratio? It means that if we capitalize asset along with liability, how it's going to affect the ratios. So as liability increases, so it would going to affect the gearing ratio. As liability generates interest cost, so interest increases, so it would affect the cover as well. So interest cover would decrease. Return on capital employed, because it increases the capital employed. So when capital employed changes, then we have to find out the impact on ROC. ROC formula is PBIT divided by capital employed. So what would be the effect on capital employed? It means liability results in increase in debt and finance cost increases, which reduce the profit. So there is a fall in equity. So overall, the impact is return on capital employed would be decreased. Another question. On 1st January 20X6, Lotsu entered into an agreement to lease new machine under a 5-year lease with 300,000 payable on year end, that is in arrears. The useful life of the asset is 6 years. Lease term is 5 years. And ownership transferred to Lotsu at the end of the lease. The interest rate is 6%, and the present value of lease payment is 1263. On 1st January, L sold its head office to a finance company but continued to use the head office for the remainder of its 20 years life under a lease agreement. This is basically sale and lease it back. The carrying amount of the head office on 1st January was 10 million. Fair value of the asset and sale proceed was 11.5 million. What would be the finance cost against machinery lease for the year ended December 2006? What would be the finance cost? So initial lease liability is 1263. Rent will be paid in arrears. So we have to apply finance cost at the rate of 6%, and that results in 75780. What current liability will be recorded in the statement of financial position as at 31st December? So we need to prepare an schedule, that is opening liability, then interest would be due, then rent would be paid at year end, and the closing liability. First year, opening balance 1263, interest was 76, rent paid is 300. So 1263 plus 76 minus 300, 1039 is the total obligation, total liability. Within 1 year, what we need to pay? The next year interest would be 6% on this 62. This one is the annual rental, and the liability after 1 year would be 801. So it means that the difference between 1039 minus 801 is 238, is the current portion. That is 238. What is the carrying amount of the right to use asset? The initial value of right to use asset is 1263. Now, term of the lease is 5 years. Life of the asset is 6 years. But as ownership will transfer, so we'll depreciate this by 6 rather than 5. So 210.5. This is the depreciation, and carrying amount would be 210.5. So it's 1263 minus 210.5. It's 1052.5. It's 1052.5. Answer is C. What would be the carrying amount of the head office at 31st December 20x6? Now see, this is a sale and lease back. So in that case, the original value which is given 10 million. So we need to check whether it's recognized as a sale. So the value carrying amount is 10 million and the fair value of asset and sale proceed is 11.5 million. So the asset is sold, but it is again on leased. So that means the asset don't need to be derecognized and it will remain at the value 10 million. So the remaining life is 20 years. So 10 divided by 20, 500,000 is the depreciation. So the thing is that as we don't need to derecognize this, so 500 is the depreciation per annum and the book value is now 9500. In million, it is 9.5 million. 10 million minus 0.5. So it's 9.5. Identify if the statement below are true or false. In a sale and leaseback transaction, no profit will be recognized by the lessee. It is possible when the seller lessee does not retain use of the asset over its remaining life. So false. If the asset is derecognized, then profit is to be recognized. In a sale and leaseback transaction, the sale proceed will usually be treated as a loan to the lessee. Not always. It is to be treated as a loan only where the seller lessee retain use of the asset over its useful life.